welcome to this explainer. If you want to master the mechanics of Nigerian partnership taxation without getting bogged down in dry legalese, you are absolutely in the right place. Today, we're going to build a clear, step-by-step visual blueprint of how partnerships and the partners themselves are actually taxed in Nigeria. So let's just dive right in.
To make this all super manageable, we've got a 5-step roadmap for you. We'll be covering the partnership tax rule, computing partnership income, handling business changes, tax-exempt deductions, and wrapping it all up with calculating the final bill.
All right, step 1, the partnership tax rule. Who actually pays?
Let's kick things off by challenging a common assumption. When a partnership makes a profit, who do you think actually pays the tax? Take a second to think about how you assume the tax authorities view the business itself.
Well, here is the absolute golden rule of Nigerian partnership taxation. The partners pay the tax, not the partnership. That's right. The business itself isn't the taxable entity here. Instead, each individual partner is assessed on their specific share of the profit. And what's really interesting is how and where this happens. You're assessed on a preceding year basis. Plus, the tax authority in charge of your case is determined entirely by where the firm's principal office is located on the very first day of the assessment year or whenever it was first set up during that year.
So, what exactly makes a partnership, legally speaking? If we look at the Partnership Act of 1890, it's defined as a relationship between persons carrying on a business in common with a view of making a profit. Under standard Nigerian law, that means you need a minimum of 2 and a maximum of 20 members.
But, there's always an exception, right? Under the Companies and Allied Matters Act, specifically Section 19, if you're practicing as legal practitioners or chartered accountants, your firm can legally blow right past that 20-partner limit. It's a very specific and very important carve-out for these professional practices.
Moving on to step 2, computing partnership income, or as I like to call it, baking the tax pie. Let's get into the actual mechanics. Think of computing your firm's income like baking a giant pie. Before anyone gets a slice, you have to figure out the total size of that pie. The business deducts its allowable expenses. Now, unlike a sole trader, things like partner salaries, interest on capital, and even leave passage costs are actually considered allowable expenses. Pretty cool, right? However, the tax authorities will absolutely disallow any private or domestic expenses. Capital allowances are also deducted from the adjusted profit before anything is shared out. And hey, if the pie burns and the partnership takes a loss, that loss gets shared among the partners based on their agreement, set off against other income, and any leftover loss is just carried forward to offset future profits. So, what exactly is in your personal taxable slice of that pie? It's not just your basic share of the profit. Actually, your taxable income from the firm is your share of the profit, plus any salary you draw, plus interest on your capital, plus the cost of your passages. If any of those are charged in the firm's accounts for you, they all roll up into one big personal taxable income package.
All right, step 3, handling business changes, specifically admissions and retirements.
Businesses are living, breathing things. They change. And when your partnership structure shifts, it triggers some very specific tax rules. Let's look at the 2 big ones. If you bring in a new partner, that person is treated like they just commenced a brand new business, which triggers the commencement rule for their taxes. On the flip side, if a partner retires, resigns, or passes away, they are deemed to have ceased business, triggering the cessation rule. But here's a fun loophole. If a partner resigns just to join another partnership in the exact same kind of trade, neither rule applies. They're considered to be in continuous business and are just assessed on that standard preceding year basis.
But what if the change is massive? Say, 2 partnerships merge or amalgamate. Surprisingly, you dodge both the commencement and cessation rules entirely. The qualifying capital expenditure simply transfers over at its tax written-down value. No messy balancing adjustments. But if you decide to convert your partnership into a limited liability company, that is a whole different ballgame. The old partnership officially ceases, triggering cessation rules, and the new company commences. That means commencement rules kick in, and yep, you're going to have to compute balancing adjustments on those transferred assets.
Moving to step 4, tax-exempt deductions. Let's talk about protecting your money.
This is where we bring in the financial shields. Before any tax rate touches your hard-earned money, you legally have the right to protect a chunk of it. For instance, the National Housing Fund lets you deduct 2.5% of your basic monthly salary, assuming you earn 3,000 naira or more. Then there's the National Pension Scheme.
Under the 2014 Act, if your firm has 15 or more staff, you can deduct minimum contributions of 8% for employees and 10% for employers. You can also shield the annual life assurance premiums you paid in the previous year for yourself or your spouse. And finally, gratuities, that lump sum paid when an employee retires after years of service, those are completely tax deductible too.
We also can't forget the National Health Insurance Scheme, or NHIS. This is another major tax-exempt deduction, but the math depends entirely on what sector you're in. If you're in the federal public sector, the employer chips in 3.25% and the employee pays 1.75%, totaling 5% of the consolidated salary. But in the private sector and other government tiers, it's a bit steeper. Employers pay 10% and employees pay 5%, bringing the total to 15% of the basic salary. The great news? These contributions come straight out of your wages and are fully tax deductible.
And finally, step 5, calculating the final bill. Let's do the math.
So let's bring the whole shebang together. How do we actually calculate the final bill? It's a strict 4-step process. Step 1, compute your gross income. This is literally all your money. Profit share, salary, interest, minus the non-taxable stuff, and those awesome tax-exempt shields we just talked about. Step 2, deduct your consolidated relief allowance, or CRA. Step 3, this simple arithmetic gives you your actual chargeable income. And finally, step 4, you take that chargeable income and run it through the personal income tax table. Now, I want to hit pause on step 2 for a second and highlight a magic baseline number, 200,000 naira. The CRA formula is absolutely crucial for minimizing your tax bill. Basically, you get a relief of 200,000 naira or 1% of your gross income, whichever number is bigger. You take that higher amount, and then you add a flat 20% of your gross income right on top of it. That entire combined chunk of money, it is completely shielded from tax. It's a massive relief.
Once you've carved out that CRA, you're left with your chargeable income. And in Nigeria, this isn't hit with one giant flat tax rate, it's taxed progressively. Think of it like climbing a staircase. The first 300,000 naira you earn is taxed at a modest 7%. The next 300,000 naira bumps up to 11%. The next 500,000 naira hits 15%. The next 500,000 naira is 19%. And the next 1,600,000 naira is taxed at 21%. Anything you manage to earn above that 3,200,000 naira mark is taxed at the maximum rate of 24%. So we've walked through the entire blueprint, and I want to leave you with one very important question to chew on. Is your partnership agreement actually optimized for your tax bill? Remember what we said earlier? It's your partnership deed that dictates exactly how profits are shared, how salaries are drawn, and how losses are handled. Since you and your partners pay taxes based directly on those distributions, mastering that document is literally the key to mastering your personal tax bill. I really hope this explainer gave you the clear, actionable insight you need to confidently tackle partnership taxation in Nigeria. Thanks for joining me.